Hi everyone, Alex from Summerhill here. In today's update, we'll cover just a quick update on the proposed higher tax on super balances above 3 mil, also known as Division 296. A general market update, our comments about the recent collapse of Shield and First Guardian and how we avoid these types of investments in client portfolios, how we review our investment platforms, and an update on cybersecurity and how we protect our clients. So, starting off with an update on Division 296, I attended a technical session on the matter this week. The proposal to impose a higher tax on super balances above 3 mil hasn't yet been introduced into Parliament, so there's no new updates since the one we made last month. We're monitoring the situation closely and will be in contact with clients if and when the legislation passes. Until then, we don't recommend making any changes or restructuring your super, as the details are not yet confirmed. Moving on to a general market update. How quickly things can turn in markets. Markets have certainly bounced back quite sharply since the pullbacks in March and April, with many markets now reaching all-time highs. Some comparisons are being made with the current market environment to that of the tech bubble in 1999. Now, back in 1996, the then Fed Chair, Alan Greenspan, warned about high valuations, yet markets grew 33%. The S&P grew 33% in 1997, 28% in 1998, and then a further 21% in 1999 before the dot-com bubble finally burst in 2000. While today's environment isn't necessarily the same, I mean, tech companies now have quite strong profits. There are some similarities. There's a lot of speculative activity, there's high valuations, there's a lot of hype around AI, IPOs, and meme stocks. Now, predicting markets in the short term is impossible. Human behavior, fear, and greed drive swings, and no one knows when the pendulum will change direction. Investing for the long term is the best way to navigate this uncertainty. For example, an investor in the S&P 500 invest in 1996 would have earned roughly 10% per year despite two 50% market crashes, 9/11, wars, oil price extremes, the pandemic, and multiple corrections. So if you're fully invested, you must be prepared for volatility or diversify to reduce its impact. Now, we certainly acknowledge valuations are high at the moment, but rather than trying to time markets and predict market peaks, we believe a better strategy to consider if you're nervous is to pause new share investment purchases until more favorable opportunities appear. Use now as a time to rebalance portfolios if the growth exposure is too high or has gotten out of whack with the recent market increase. And to also use now as a good time to take some profits from shares if you need cash for some upcoming goals and expenses. These are all things we consider in these times. So for some of you, you may find that cash is accumulating in your portfolios. This is a conscious decision by us given the current market environment. Now, moving on to the collapse of Shield and First Guardian. So, many of you may have read over the past few months that three public super funds, First Guardian, Australian Fiduciaries, and Shield Master Fund, have collapsed, costing investors around $1.2 billion. This is devastating, and our thoughts are obviously with those infected. However, there were several red flags with these investments that were clear to anyone that took the time to do some due diligence before investing. Making life-changing investment decisions on the strength of comparison websites without doing any due diligence into how these funds invest, who the investment managers are, and their track record is a recipe for disaster. When it comes to investing, humans are driven by fear and greed. As long as greed plays a role, both from promoters, from pushing these questionable investments, and from investors seeking to sort of chase those quick returns without proper due diligence, these kinds of situations will continue to occur. I'd like to make it clear that these types of investments are entirely different from the investment portfolios we construct for clients. Many failed investment schemes we've seen over the years share common themes: exposure to unlisted property or private companies. In First Guardian's case, investor funds were channeled into property developments and equity into related entities, raising serious governance concerns. In contrast, the funds we use are highly diversified, invested into liquid public share markets, and commonly share markets, shares, and bonds. We deliberately avoid high yield debt, private equity, unlisted property in client portfolios due to the liquidity and the governance risks, and also taking into account their return expectations and at times also overly complicated investment structures. We predominantly use managed fund investments operated by Dimensional and have done so for close to 20 years that Summerhill has been operating. Dimensional was founded by Nobel Prize winning academics in the US and has been operating for 50 years. Even during the global financial crisis, their funds remained opened and redemptions were never frozen, which is a highly important consideration for us. We take investment due diligence seriously. While a globally diversified, evidence based approach to investment may not be flashy, it's grounded in sound investment principles and it lets us sleep well at night. It's also how Caroline and I invest personally, along with our immediate family. We also regularly review the investment platforms that we use to implement client portfolios. So, our criteria includes cost-effective access to wholesale managed investments that we believe are in the best interest of our clients. We use providers like BT and Macquarie purely as an administrative platform. We do not invest into any of the BT and Macquarie investment schemes or managed funds. Instead, we select the wholesale managed funds, like those offered from Dimensional, based on our due diligence and alignment with our investment philosophy. We also look, when it comes to platforms, at investor protection and using licensed custodians as an extra layer of protection. And cybersecurity is a huge focus. So both BT and Macquarie gain access to bank grade security, which is an important consideration for us. This careful approach helps us avoid the risks associated with failed investment schemes. Now, finally, cybersecurity update. Scams are becoming more prevalent and sophisticated, especially with AI. We at Summerhill regularly review and engage external specialist IT firms to review our systems and cybersecurity processes, and we're currently going through a review at the moment. You'll also notice that we're going to be communicating to you more through the Summerhill portal, particularly for sensitive documents. This is just a way to manage risk and the risks associated with email. For those clients who aren't tech savvy, we'll work with you individually to ensure you're comfortable with the communication approach while maintaining strong protections for your data. Well, that's it for us today. If you have any questions, please don't hesitate to reach out. Thanks for watching.